Hi, this is Mr. Evans. This video is going to look at a question on cash flow versus profits from Unit 5. The question I'm looking at is discuss the extent to which cash flow is more important than profits to a growing business like Warren Evans. So just to break down the question a little bit, what's the instruction in the question? The instruction is discuss. What's the context that I need to talk about? It's a growing business. And the focus is profits versus cash flow. You'll notice it says a growing business like Warren Evans, so I can use Warren Evans, but I can also use any other business as long as it's a growing business to form my context in this question. Now, the reason I picked Warren Evans is because Warren Evans is a very interesting company. It went into administration earlier on this year, and I was very, very surprised when Warren Evans did go into administration. I bought a bed from Warren Evans in 2010, and I was very impressed. The organisation had a very, very good reputation. It often got write-ups in papers like The Guardian because it was considered to be quite an ethical company. And the other thing that was going on was it was expanding. So I kind of followed Warren Evans since 2010 because I was interested in the company, and they had been expanding. And then the announcement came out at the beginning of 2018 that they were going into administration. And so I was quite surprised about that. So this case study has been, I've copied these from various websites to put together a little case study that we'll just quickly have a read of. Remember, the question is, to what extent is cash flow more important than profits to a growing business? Popular luxury furniture retailer Warren Evans has gone into administration and it's been unable to meet its obligations to its creditors. In other words, it's been unable to pay its debts. The sudden move has taken many by surprise as the company has a strong reputation with customers and has been expanding in recent years. The announcement comes as reports emerge that Warren Evans is on track to make a loss of nearly $2 million this year, despite sales of $27.3 million, yielding profits of £837,500 last year. Okay, so I should look at that when I'm reading the case study, and I should immediately think, okay, I can do a calculation here. Right, you can calculate the profit margin on that. Warren Evans is rightly recognised as one of the UK's leading bed, mattress and furniture retailers, but trading conditions are exceptionally challenging, with the business hit by rising manufacturing costs and the continued squeeze on consumer wallets and confidence. So there's indications here that the cash flow might be struggling, costs rising, squeeze on consumer would have increased their outflows. The squeeze on consumer wallets and confidence would have reduced their inflows. Over the past year, the business has been growing its market share with major investments in new product development. So again, more money flowing out of the company. However, the search for new investors to prop up the company's cash flow has proved to be ultimately unsuccessful. In other words, they've gone out and they've tried to find investors to put money into the company so that they've got more liquidity, they've got more money coming in. And so the business and management were left with no option but to go into administration. So this is a classic case of over-trading when I'm reading it, when a company grows too quickly and it basically runs out of cash as a result. It seems that Warren Evans had borrowed money in order to fund their expansion, and they've been unable to pay it back. In 2013, the retailer issued $2.5 million of retail bonds to fund the opening of new showrooms. Okay, retail bonds are a form of borrowing. It's not on the spec, but basically a bond is a piece of paper that an investor can buy, and you buy the piece of paper for a certain amount of money, and then Warren Evans promised to give you a certain amount of money back in the future. So around 2 million of the bonds, which still carry an interest rate of 7.5%, are still thought to be outstanding. So in other words, Warren Evans owes a lot of money. He's borrowed that money to fund their expansion, and it appears that they're running out of cash to pay that off. Okay, so what am I thinking about my essay? Well, it looks like to a growing business like Warren Evans, cash flow was more important than profit because they made a profit last year and they're still going into administration. So I've got a plan to answer my essay, which is always important, but what I want to focus on particularly in this video is how I start each of my analytical paragraphs with the point that I'm going to develop. I use information from the case study to back up the point. I build an argument using connectives, and I clearly link back to the question at the end of it. So, as I keep saying in these videos, one of the things the examiner likes is to see that you've planned your answer before starting. I've defined cash flow and profits at the beginning, but then I've said having sufficient working capital is essential for any business, but a growing business can be at risk of over-trading, making the need for cash even more essential. Working capital, over-trading, I already sound like a business student to the examiner, which is good, and I've told them what my conclusion is going to be, which is cash is essential. So, how do I start my first paragraph, focusing on why cash flow might be more important than profits? Well, the case study makes clear. The case study makes the importance of having sufficient cash flow to enable a growing business to meet its liabilities very clear. In other words, I've started off the analytical paragraph with a point, and now I'm going to try and develop that. Warren Evans was popular with customers and had been expanding in recent years. Okay, that's information I've got from the case study. However, connective, it chose to expand by issuing bonds at a high interest rate and investing large amounts into product development. Okay, from the case study. Connective, it seems that Warren Evans was unable to meet their debt obligations to bondholders, perhaps because of their major investment and the increase in raw material costs over the past years. Okay, so the green bit is kind of when I've gone into a bit of analysis. Okay, I've taken this case study and I've said what it means to the business. They've been unable to meet their debt obligations because they issued bonds that need to be repaid, and they've invested a lot into product development. So I've taken those points with a connective and I've said what it means for the company. That's basically analysis there. Perhaps because of their major investment and the increase in raw material costs over the past years. So again, information from the case study. It's called contextual analysis. I'm building an argument using the information in the case study. It could be connective that the company has spent a lot of cash in order to grow its market share, but had insufficient funds coming in to resource their stock purchase and debt repayment. So this is basically answering the question, isn't it? It's about cash flow. They've spent a lot, their outflows have gone up, but they've not had enough money coming in order to resource their stock purchases and debt repayment. The phenomenon of a business running out of cash as a result of their growth is known as overtrading. Excellent. I really sound now to the examiner like a business student, because I've been able to spot that this is a case study about overtrading, even though it never mentioned that term in the case study. Warren Evans was unable to attract new funding despite making a profit last year, which shows that retaining sufficient cash flow is essential for a growing business. I've linked it back to the question, basically saying cash flow is essential for a growing business. Okay, really clear link back to the question. All right, so you can think about where I've shown those aspects of making a point, developing it in context, and linking back to the question in this paragraph. In the long run, making a profit is essential for all businesses to survive. However, it is arguable that a growing business can survive without making a profit for several years. Amazon is a classic example of a business that prioritized growth above making a profit for many years. Amazon focused on revenue growth and investing in building infrastructure to enable it to access new markets. Amazon was able to grow without making a profit due to exceptional revenue growth that attracted investors and enabled Amazon to have sufficient funds for working capital. Now, this is true. This graph here shows you Amazon's sales since 1998. Huge increase in sales revenue. But actually, for many years, Amazon didn't actually make a profit. You can see that the profit line here in red is basically at zero, right the way they've made profit in some years. But it's only in recent years that that profit figure has really started increasing. So Amazon are a classic example of a growing business that hasn't made a profit, but it's been able to survive because people have been really interested in Amazon's business model and investors have wanted to put money in. Warren Evans went into administration even having made a profit last year, albeit a relatively low one, demonstrated by the profit margin of 3.07%. Okay, so I've said here at the beginning that making a profit is essential for all businesses to survive. Then I've explained that Amazon were able to survive without a profit for a long time. But now, remember, I need some balance in my essay, and this essay is looking a little bit unbalanced to me at the moment, because basically this is why cash flow is important, and most of this paragraph on profit is talking about why profit isn't important. So now I need to make sure I explain to the examiner that I know that profit is actually important in the context of a growing business. Making profit is important for a growing business because it can provide funds for investment and attract potential shareholders and lenders. Perhaps if Warren Evans were expected to be profitable this year, they would have found it easier to attract funding for their expansion. However, the case study makes it clear that even a profitable business can run out of money, meaning that cash flow may be considered more important for profit for long-term survival. So I've tried to link back to the question here. The case study makes clear that even a profitable business can run out of cash flow, meaning that cash flow may be considered more important than profit for long-term survival. So I have got some balance in this essay saying why profit is important for a growing business, but I've been building up to my conclusion all the way through that cash flow is more important for a growing business than profit. So here's my conclusion. In conclusion, the Warren Evans case makes it clear that a growing business cannot survive without sufficient cash flow to fund their working capital. This is because without sufficient cash to meet its liabilities, even a profitable business like Warren Evans can go into administration. However, in the long run, nearly all businesses will need to make a profit in order to survive. This is because making a profit gives the business a chance to finance both its day-to-day operations and reward shareholders for investing. At some point, an unprofitable business is likely to run out of cash. So what have I done here? I've answered the question. A growing business cannot survive without sufficient cash to fund their working capital. I've supported this with evidence from my case study. Even a profitable business like Warren Evans can go into administration. But what's the problem? How can I get some balance into this conclusion? In the long run, nearly all businesses need to make a profit in order to survive. Well, and I'm going to support that. This is because making a profit gives the business a chance to finance both its day-to-day operations and reward shareholders for investing. At some point, an unprofitable business is likely to run out of cash. So I've got a balanced conclusion here. Sometimes I try to put a solution if I've identified a problem. In this case, I've tried to develop this into a more advanced conclusion by looking at short and long term. Okay? In the short term, it's working capital, but in the long run, businesses will need to make a profit. So I hope that's helped clarify the difference between cash flow and profit and given you some examples that you could use in the coming exams.